Experts warn Florida is facing the biggest real estate collapse in U.S. history. Insurers are fleeing, premiums have soared up to 500%, and a home that sold for $650,000 in 2022 now sits unsold at a loss. The sudden reversal has pushed out more than 250,000 people in just months. And the 2021 alone, Florida's net migration outpaced Texas, Arizona, and the Carolinas combined. Local officials scrambled to keep up, issuing new building permits and adding lanes to highways that jammed with out-of-state plates. The state's overall growth rate was the fastest since the 1950s land rush. Signs of the boom were everywhere. Sold-out new construction, wait lists for condos, lines at open houses that stretched down the block. For 2 years, demand seemed endless. Every new arrival added fuel to the fire, pushing the buyer pool higher and higher. The promise of sun, base, and opportunity drew more people to Florida than at any point in recent memory. But behind the numbers, a speculative mindset began to take hold, one where the only direction for prices and fortunes was up. Home prices in Florida didn't just climb, they rocketed. In Miami, Tampa, and Orlando, the median sale price soared by 45 to 60% in less than 2 years. Bidding wars broke out over every 3-bedroom ranch and high-rise condo. Listings that once lingered for weeks vanished in hours. Agents started skipping open houses altogether, knowing the home would be under contract before the weekend. Cash ruled the market. Investors and out-of-state buyers came armed with wire transfers, beating out anyone relying on a mortgage. And everyone seemed to know someone who'd just made 6 figures on a resale. The fear of missing out drowned out caution. Numbers backed up the frenzy. In Tampa, cash buyers made up nearly 40% of sales in 2022. In Miami, investor purchases hit all-time highs. Title companies worked overtime, closing deals at a pace not seen since the last housing boom. Behind every record sale, there was a buyer convinced that Florida was different this time. But as prices climbed and the market heated up, the risks hiding beneath the surface grew larger and far harder to ignore. Every new hurricane season brought fresh fears. After Hurricane Ian in 2022 and Idalia in 2023, carriers faced billions in claims. Global reinsurers, who provide the financial backbone for local insurers, raised their prices by 30 to 50%, or pulled out entirely. Florida carriers now spend more than half of every premium dollar on reinsurance, double the national average. The math no longer works. Insurers say actuarial models predict losses that can't be covered, not at any price homeowners can afford to pay. Even the state's legal reforms, meant to cut down abusive lawsuits and fraud, haven't been enough to lure carriers back or lower costs. The swelling ranks of Citizens policyholders come with their own risks. Citizens was designed as a safety net, not a primary insurer for a state of 22 million people. Its reserves are built for a 50-year storm, but a single 100-year hurricane could wipe out its ability to pay claims. If that happens, every Florida policyholder faces the prospect of emergency assessments and higher taxes to cover the shortfall. Internal actuarial reports warn that Citizens' financial cushion is thinning with each new policy added. The more the private market shrinks, the more the state becomes exposed to a disaster it cannot fully insure. Industry filings show that in high-risk counties, more than half of homeowners now rely on Citizens for coverage. In some coastal zip codes, private insurance is no longer available at any cost. The problem isn't just storms, it's the cost of reinsurance, the volume of lawsuits, and the growing sense among global insurers that Florida's risk is unmanageable. Each carrier that leaves deepens the crisis, pushing more homeowners toward a system never meant to carry this weight. The safety net is fraying, and with every hurricane season, the risk grows that it won't hold. Retirement in Florida once meant sunshine and peace of mind. Now it comes with a stack of bills that many never planned for. In Naples, a retired couple opens their renewal notice and finds the premium has jumped from $3,000 to $14,600 in just 3 years. Their neighbors, living on the same street, face an even steeper climb. One couple's waterfront policy now exceeds $18,000 a year. These aren't luxury mansions. They're modest homes, built for quiet years, now priced out by a system that no longer makes sense. Monthly budgets have become battlegrounds. For a median-priced house in Tampa, insurance alone runs between $4,200 and $6,500 each year. That's 3 to 5 times the national average. Property taxes, once a selling point, have climbed by 25% in many counties as new assessments catch up to the boom. In some neighborhoods, HOA fees have soared by 30% or more, as entire communities scramble to cover their own insurance gaps. Every line item gets squeezed: maintenance, reserves, even basic utilities, until the numbers no longer add up. Further inland, the picture is different but far from stable. The Villages, a sprawling retirement community once thought immune to coastal risk, is now seeing its own correction. Prices have flattened, and some neighborhoods report double the number of homes for sale compared to last year. Rising insurance costs and HOA fees are hitting even these planned communities, prompting some retirees to reconsider whether Florida is still the right place for their fixed incomes. Rental data shows the same pattern. In Panama City Beach, average monthly rents have dropped 12% in a year, with vacancy rates climbing. Inland suburbs, once insulated from the worst of the storm-driven chaos, are now facing a slow bleed as investor demand fades and population growth stalls. The pain is sharpest where climate risk and insurance costs intersect, but nowhere is truly untouched. The map of Florida's real estate collapse is a patchwork: coastal, inland, north, and south, each with its own version of distress, but all pointing to a market where the old rules no longer apply. In just 2 years, Florida's net migration flipped from a record inflow of 700,000 new residents to a net loss of 275,000 people in early 2024. This reversal, combined with an 85% surge in housing inventory and insurance premiums that have risen 400 to 500%, has exposed the fragility of Florida's real estate boom. Documented failures in the insurance market, escalating costs, and climate-driven disasters like Hurricane Ian's $113 billion in damages have led experts to warn of further declines, another 20 to 30% over the next decade. Yet, the full impact on regional banks, state finances, and future migration remains unclear. What is certain is that the collapse was driven by measurable risks: unchecked population growth, speculative investment, and mounting climate threats. As policymakers scramble for solutions, the evidence shows Florida's reckoning is reshaping the national conversation about where Americans live, invest, and retire. The consequences of this crisis will unfold for years, marking a turning point in U.S. real estate history.